Welcome to the new video. In today's video, we will take a look at the issues surrounding the US economy and stock markets, which will likely result in a potential drop in the stock markets. Towards the end of the video, I will share my current investment strategy. Listen to what leading economist David Rosenberg says about it.
Well, the stock market hasn't really been rallying since the Fed started raising rates. That was back in March of last year, and last year the S&P 500 was down almost 20%. Of course, we've had the generative AI boom going on, so on and so forth. It sort of looks a little bit like the internet mania we had back in the late 1990s. Again, it was partly fundamental, but that was a massively momentum-driven market.
The first indication of problems is the continuous rate hikes, as almost every time the Fed increases rates, it has led to subsequent crises or recessions. As you can see, rates have been increasing since March 2022, but now they are at their highest level in the last 15 years, and the rate of increase is the fastest since 1981. As David Rosenberg mentioned, the value of the S&P 500 index decreased by 20% from January 2022 to October 2022, and subsequently, the AI boom slowly began, which increased the value of the S&P 500 index by about 20% to the same level. The main problem of this growth is that companies haven't started earning much from AI yet, despite the value of their stocks having increased by as much as 100% in the last few months. David also says,
Next 12 months is going to be really rough. That's when all the lags from the Fed are really going to be kicking in hard. Such a deeply inverted yield curve, which of course everybody says is a relic of the past, ignore the yield curve. They say that every cycle. I think the Fed has already gone overboard. Then again, maybe a recession was always in their plan to destroy the inflation they created through the overly accommodative policies they pursued in 2020 and 2021. So we'll correct one mistake with another mistake.
The last, but the most fundamental problem is the inverted yield on US government bonds. This fact truly shows us that the US economy is still not in good shape, and that the few months of rising stock markets were merely a boom of AI. When we look at the charts of US 2-year Treasury and US 10-year Treasury, we notice something that contradicts logic. It is entirely logical that when you have a bond for a longer period, it should yield more than when you have a bond for a shorter period, but this fact contradicts that logic. When you buy a 2-year US government bond, it will yield 1% more annually than when you buy a 10-year US government bond. As you can see on the graph, the black line represents a 0% difference between the bonds. When the graph is below the black line, it indicates a scenario where the 2-year US Treasury had a higher yield than the 10-year US Treasury. Moreover, we can observe that every time this situation occurred, a recession followed, indicated by the gray bars. Additionally, we can notice that such a difference between these two bonds was last seen in 1980. Because every time in the past, when the yield of the 2-year US Treasury was higher than the 10-year, a recession occurred, and stock markets were falling down, I expect a very similar situation to happen now. Due to all the reasons we discussed in this video, I have sold stocks such as Tesla, Microsoft, Nvidia, Apple, Meta, and others. These stocks have been riding the AI boom the most, and I anticipate the most significant decline for them. However, I am confident that the AI boom will return eventually, once companies start profiting from AI, and their prices will rise again by tens of percent. That is the reason why I will gradually invest the most money into these companies, when their prices will be lower due to recession and the fall of the stock markets than they are now. I think that if you are properly prepared for this recession and buy stocks of great companies at a good or great price, you may be able to gain hundreds of percent from your investment. Thank you for watching. If you enjoyed the video, don't forget to like this video, subscribe to the channel, and share the video. Bye.